Hello everyone and welcome to another episode of Let's Talk Real Estate. I'm your host Anthony Giglio with RE/MAX Legacy here in Woburn. Today on my show I'm excited to introduce a very special guest. He's not only a friend of mine, but he's one of top mortgage brokers here in Woburn, Fred Damore with Ross Mortgage.
Hi everybody.
Fred, welcome to the show. Glad to have you here.
Thank you, Anthony.
Now, Ross Mortgage has a local office here in Woburn.
Yes.
But they also have offices all around Massachusetts. So.
Yep. We have Franklin, Leominster, Westboro is our head office.
And what do you do specifically at Ross Mortgage?
We just work on residential mortgages, singles through 4 families.
So you work for a mortgage company on residential loans, and coincidentally enough, you're here on a real estate show.
Yep, that's right.
So this works out perfectly. The title of the show today is The Key to the Home Buying Process. And the reason why I brought Fred on is because I believe the key to the whole process starts with the whole loan, or what we like to say in the industry is getting pre-qualified. And Fred, I invited you on because I know you have a good expertise on this subject. And I wanted to talk a little bit about getting pre-qualified. Now, I guess the number one question people are going to ask is, why get pre-qualified?
Well, one of the things that happens is most people don't know exactly what they can afford. They don't know what they have to put down for a down payment. Some people still think they need to put 20% down, where they can get away with 3.5%. And they just don't know what their monthly payment's going to get them for a size of a house in a particular area. So that's the main reason. The second reason to start early on this is if there's any blemishes or anything that needs to be fixed, we could fix it now up front before they go and see houses.
That makes perfect sense. I know that when I meet with a buyer and they want to go look at a bunch of homes, I ask them, have they been pre-qualified? And they want to know why. Why do I have to get pre-qualified? And I always like to, some of the things you mentioned. We need to know what you can afford. We need to know that we're looking at the right homes. We could spend days and days looking at homes that aren't even in their price range because they didn't take the time to meet with someone like yourself, sit down, go over their financial situation, figure out what they can afford, and then from there start, putting a search together. And that's why I like to say that getting pre-qualified is the key to the home buying process, because without getting pre-qualified, you really don't know what you can afford, you really don't know what type of house you should be looking at, and you're not really making an efficient use of your time.
It's true, Anthony. I've had people that go online, try to figure out what they can afford for a single family home, and they're looking for condos. They don't realize that there's a condo fee that's going to affect their payment as well. They don't realize that they might not be able to afford it because of that. So they need to really focus on finding out what they're going to do, how much they're going to put down, and exactly what the payments are going to be.
We mentioned condo fee, but also like real estate taxes, insurance,
yep.
Things like that people don't factor into, okay, that's also going to be factored into what I can afford.
Monthly payment.
Sure. Now, I mentioned the word pre-qualified, and I know there's a little confusion in the real estate industry amongst a lot of buyers and even some home sellers of what pre-qualified is, because I think that's a relatively new term in the industry because most people call it a pre-approval.
Yep.
But I know there's a distinct difference.
There is.
Could you explain a little bit what a difference between pre-qualified versus pre-approval?
Well, pre-approval is a full underwrite of a file. So it's the same thing as applying for a mortgage with a full application signed, with verifying your tax returns. A full mortgage takes a couple weeks to do, just like a regular mortgage would. It's just without the property. Now, it has to be signed off on by an underwriter, and also it would be dated as to how long it's good for, because the pay stubs are going to expire, W-2s, their credit report's going to expire. So there's a date that it would be good for. What most people do, myself included, is a pre-qualification. What we do is we verify their pay stubs, and we're looking for, what their income is, their overtime. We verify their W-2s, the length of employment. If they're self-employed, we look at their taxes. We're also going to look at their bank accounts. And what's important there is we want to see if there's any deposits over $1,000. Because for a pre-qualification, we need to make sure that we're going to be able to tell them that they can get a mortgage without any issues that could come up. And some people deposit cash in their accounts, so we're able to see that up front and tell them how to deal with that. As far as other things with the pre-qualification, it's the quickest way to do it to be able to see a property and get an offer in.
Right, I would agree with that. Now, I have buyers that come in and say, well, I made a phone call to just a bank, and they took a couple of information over the phone and then issued me a letter right off the bat. And so I asked them, okay, well, did they run credit? Did they check your pay stubs? And I see that a lot happening where they get this pre-qualification letter, but it's not a true pre-qualification because none of that, the things that you mentioned were actually checked.
Well, there's a couple things that have to be done. Your credit has to be checked.
Well, let me stop you right there. Why is that important?
Why is it important? To see if there's any blemishes. You might think your credit's perfect, but there could be something old that shows up. Could be something that somebody has an identical name, a father, sister, brother, account that was joint at one time. There could be a lot of things on there that can be fixed, but there could be things on there that take time to fix. So the sooner we see it, the better. And it just verifies what your monthly payments are going to be. Some people don't think that they have, for example, student loans. They owe the money, but they don't realize that we're going to use the debt against them even though they're not paying back the debt for deferment. You know, the debt's in deferment, but we're going to have to use that against them, so we still have to see exactly what they owe so we can figure out how much to use against them.
And also know when you look at the credit report, you can, and someone may not qualify based on the credit, you can tell them, okay, if you were to pay this amount down, then your credit score would potentially, increase a little bit, and you'd be able to afford it, or your debt-to-income ratio would change.
We can tell them what to do to be able to afford more. We can tell them, maybe they should be looking at something less, smaller home. We could just help them fix their credit scores in general. Sometimes people just overspend and they don't realize it by having high balances on credit cards. Even though they have the money to pay it off every month, they just keep a high balance on there. And sometimes that affects your scores, which a little bit higher gives you a little bit better rate, and that makes you qualify for more.
So since we're on the topic of credit score, I know a lot of people feel like, well, I don't have a perfect credit score, so I can't buy a home. And I think that's not true. You can actually have an average credit score and still be able to, buy a home.
You can have a low credit score and still be able to buy a home.
Well, what would be low in the industry?
620 we could work with. You could even be lower because we could work with you to get it up higher. There's a lot of people that are in the high fives that with a little bit of work, a couple of months, they could get it up over 620. They'd qualify for an FHA mortgage as long as everything else is in order.
Sure.
And they can buy homes. They shouldn't be discouraged in looking, but they need to not go out and look at homes first. They need to figure out what they can do first.
I know I've sent clients to you that, we had to do a pre-qualification first, and we found out, what? You're not ready to look at homes yet because you have to do a few things. You have to do, pay this debt down or increase your credit score by a certain number of points. And then after, sometimes I think there's one client that took about a year. And then after a year, they were in the right position, and we ended up finding them a home. And they went through the process the correct way. They started with the pre-qualification.
I've had clients that 2 years I've been working with them, and then they finally bought a home. It's just a matter of getting them situated.
Right.
Some of them don't realize what they've spent over the years and what they have to pay back.
So we mentioned that you check the credit score.
Yep.
You also look at pay stubs. Okay. Now I know back in the day when I applied for a mortgage, they did what's called a no document loan, where you could just call up and say, I make X amount of dollars and pre-approve me or pre-qualify me based on what I tell you.
Not anymore.
Right. I know the industry's changed.
Yeah. We have to verify everything. Every loan done has to be verified. We use income to verify it. There's no stated income that we use anymore, no matter what you're going to put down for a down payment. A lot of people are upset with that because there are some wealthy people that do have large down payments, and they just don't want to have to bother with the process because they have so much documentation. But unfortunately, this is the world that we're in right now, and we do verify all of it.
And sometimes it's not about, not trusting the client, because, you get a paycheck and you say, let's say you're saying you make $1,000 a week, but half of that money comes from overtime, or bonus or something. And people think that that's actually the income that they can use.
That's right.
But that changes things, right?
I've had, we've looked at people's pay stubs. They think they made $100,000 and they had a one-time $50,000 bonus that year.
And you can't necessarily count that.
You can't count that.
Right.
And they think they made $100,000 for income that year, where really we have to use their base salary because next year they're going back to that $50,000 a year. The company got bought out, so they got an incentive to stay.
Right. And so from the mind of a borrower, they're in their mind, I can afford this home because I make this much money. But from a lending perspective, well, you really only made this money and you had a one-time, bonus that isn't going to probably happen again the next year.
And that's why we look at all that information.
Right.
With people that are self-employed as well, we look at 2 years tax returns. We go through them detailed to make sure that there's no problems with them affording it. Because you can write off certain things and certain things you can't, and you have to make sure that their income's going to be there to be able to afford the home.
Sure. Now, in addition to the credit check, in addition to looking at the W-2s or pay stubs or tax returns, I know that looking at where a down payment is coming from is important. And why is that important?
Well, we have to verify all funds, okay? So it doesn't matter where it's coming from, if it's coming from a savings account or a checking account. It could be coming from a Fidelity account, investments. But we have to show the money that it's yours, that you've had it for 60 days, and we have to show the money being transferred when you move it from one account to another, that it gets transferred, that it doesn't change hands. One of the things that we're looking for is that there's no large deposits over $1,000. I know people deposit over $1,000 all the time, but usually it's their payroll or pay stub, things like that. You can get gifts of money, but we have to verify the gifts.
So a parent could just say, okay, I want to give a $5,000 down payment assistance.
$5,000, $10,000, whatever they want.
How do they do that?
All they have to do, it's simple, is they have to just verify it before they put it in their account. Make a copy of the check. Give us a copy of their bank statement showing the money clearing their account.
Okay.
The customer showing the money going into their account. These are just the things we look for. When there shows up $5,000 in an account and they say, well, my mother gave it to me in cash, we don't know that the mother gave it to her in cash.
Right.
Because it has to be a relative that's giving you the money for a gift. So we don't know where that money comes from if it's cash deposited. So that's why it's good to look at the bank accounts in advance. If we see things like that, we can deal with it up front before they find a home, so that they'll be able to do it.
Excellent. That is, that's good information. Now, another misconception is you need to have a lot of money to be able to buy a home. You need to have a big down payment. I know 20% is that big number. If I don't have 20%, I can't buy a home. But that's not true.
It's not. I've seen people tell me they need 25% down, 30% down.
And in some situations, you may need it depending on what type of property. But
maybe they're buying something that they can't afford the payment themselves or be comfortable affording the payment unless they have that. But you can get away with putting as little as 3.5% down on a house.
3.5%?
Yep. And you could have the seller pay your closing costs as well. Simply when you put in the offer, you can ask the seller to pay a certain percentage of your closing costs.
So really, home ownership is not as far-fetched as some people think it is.
No, it's not. It is affordable if you just take the right steps to look into it and go forward with it.
And certainly with the amount of rent people are paying now, it almost makes sense to buy a home and try to build some equity instead of just giving your money. Yeah, I saw that rents were going
up again too.
Yeah, it's crazy what's happening. Now, as far as getting pre-qualified, people are a little hesitant about taking that step. They don't want their credit checked, they don't want to go through the hassle, but they also feel like maybe it costs something or it obligates you. Does it cost anything to get pre-qualified?
There's two things that I find that people are hesitant about. First, well, three things. One is people are sometimes scared to just make a phone call, but it doesn't take anything to make a phone call and get advice. The second thing is cost. They don't want to pay anything out because they're not sure what they're going to do. Well, to a pre-qualification, there's no cost, there's no obligation.
So it's free.
It's free.
Free.
And there's no obligation. Tony likes that.
I know, if Anthony it's free, it's for me. That's been my motto in life. So.
That is. So there's no cost at all to it. But going back to the credit report, a lot of people don't want their credit pulled because they see all this creditkarma.com, creditreport.com, you know, check my credit, it reduces your scores. It's not necessarily true that it does that. It's algorithms they use to check your scores, to create these scores. And if you haven't had it checked by a mortgage company, you should. There is going to be a different score that you get from these other companies that are out there. And they say, well, my score is going to go down 3 points. My score is going to go down this. It's not going to get affected if you're looking for a mortgage. Only it's going to get affected if you go to 3, 4, 5 mortgage companies and apply for credit.
Right.
If you do that, the algorithm's going to say, well, obviously you got denied at the first company, so that's why you went to another.
Sure.
So you need to get one credit report done from a mortgage company, have them get you a copy of it so that you can, you can give it to other companies if you need to talk to people. That way you don't have to keep getting it pulled.
Now, just to be clear, getting pre-qualified through any mortgage person doesn't actually commit you to using that mortgage company.
Not at all.
Okay, and a lot of people feel like, well, I'm not ready to make that type of commitment. You know, like me, it took me 39 years to be able to get committed to get married. So, like, I'm a commitment phobe.
You have 20 days still.
Yeah, it's coming up pretty soon here.
Yeah.
But commitment's a huge thing, and then when you talk about committing to a mortgage person, that's even like scarier.
Because people are worried. They're worried about, well, I don't know what the rate's going to be yet. Well, we don't know what it's going to be yet because you haven't found a house. So it's hard to pinpoint that stuff. We don't want you committed. We want you to just get the process started right. We want to help out our realtor friends in the business so that they know that you can buy the property. And that way you'll be able to look easier and you'll have somebody to ask questions to. Then after you find the property and have an offer in on the property and know you're going to go forward, you can shop around at different companies and you'll have a little bit more insight when you're shopping around and you can try to find the best deal.
So not only does it not obligate you to use that mortgage company, it also doesn't, the mortgage company is not committing to giving you the loan.
They're not committed to giving you the loan.
So it's not an actual loan commitment.
No. The things that happen when I do the pre-approval, it's the pay stubs, the credit, the W-2s, sometimes tax returns. We run it through the computer automated system with Fannie Mae so that it's actually run through to make sure, and we get an approval result out of that. But it's not signed off by an underwriter at that time.
Okay, so let's say someone got pre-qualified, they went out, looked at homes, found the perfect home, and then they come back to you and say, you know what, you're such a great, outstanding individual, your rates are great, I've heard great reviews about you, I want to now continue and get my mortgage through you. What is the process then?
Well, at that time, we'd have a lot of the information together because you've done the pre-approval. We would go forward with the mortgage, sit down, go through the numbers again on that particular property, make sure that particular property meets your needs, because obviously it meets your needs to live there, but meets your needs monthly payment-wise and down payment-wise. Okay. And then we'd finish off the application. The appraisal would get ordered, and then it would go into review for the underwriter.
So can you explain a little bit about why an appraisal is necessary, or what actually is an appraisal?
Well, an appraisal is the value of the property. Okay. We're sending an individual out there that goes out to find out what the property's worth and to make sure there's nothing structurally wrong with the property that's interfering with its value.
Okay.
Okay? Because we need to know. We need to know the value, because that's one of the big things we're basing it on. We're basing your mortgage on your credit history, your income, and the value. Okay, so they go out and check the property to see what it's worth, and they come out with the price. They let us know if there's any problems with the property, anything that could create any future problems with it.
Right, and it protects the buyer as well as the bank. I mean, the bank is trying to ensure that the loan that they're giving out is not bad money.
Yeah, well, the house is the only thing that backs the mortgage. So,
exactly.
We're loading the money on that particular home. We want to make sure it's a good asset.
Do you find in this crazy real estate market where people are bidding over asking price just to get the house that you're having issues with and the house actually appraising at the value they're purchasing at?
Right now, I'm not having problems with the appraised values. as homes increase, other homes are closing. So the values are going up. I found more problems with values as the market went down,
Right.
appraisal problems.
Sure.
But I'm not having many right now at all.
Yeah,
Values
I mean-
seem to be coming in. There's if it's listed by a realtor and you're represented by another realtor, there's two people that are in the business doing their due diligence to see what the value is.
Sure.
So most likely the value is going to come in very close.
Okay. So, all right. So you order the appraisal. You mentioned an underwriter.
I never get.
Okay. So what does an underwriter do?
This-
Like,
this-
why is that person necessary if you've already pre-qualified
Yeah,
them?
it's like this fictitious person that's out there
Okay.
behind the wall. The underwriter has sign off for doing Fannie Mae, Freddie Mac, FHA loans. What that means is they're able to sign off with their name, and the loan can be bought by those companies.
So they're
Okay?
kind of like a QC, like
Yeah.
quality control, making sure that you did your job, you did your due diligence to look at all the documents, and you didn't miss anything.
Exactly. And if there is something missing, they're going to condition for it and get it. So they're going to take, the file goes to them when the appraisal's in. All the other document will be there. They're going to look through every nook and cranny of it, see if there's anything missing or anything that could create problems. They'll condition to it to the customer of any conditions we need, and they'll issue a real approval. The approval is a full commitment on the loan, meaning that we're ready to fund that loan as long as we get this information back from the client.
And the loan commitment's kind of the big place where you can celebrate, because once you have that letter from the bank that says we will 100% now guarantee giving you this loan if we have these conditions met, then you know that you're free and clear. You can buy this house.
They're guaranteeing funding is what they're doing. So they're
Okay.
ready to go, and that's it.
What common problems do you see arise from the underwriting process? Are there certain things that come up sometimes that an underwriter catches or notices or sees?
I've seen all kinds of stuff, but I've seen people own properties that they didn't disclose on the application.
Right.
The underwriter finds it at the registry of deeds that they own other properties. Because a mortgage didn't show up on the credit report doesn't mean they have other liabilities out there.
Right.
People have been divorced and they never noted that, and they're obligated to pay child support, but the child support doesn't show up on their pay stubs or any of their other documentation.
Right.
So full disclosure up front is usually easiest, because we usually do find out all that information.
Okay. Then, and you mentioned the word that I was thinking of, disclosure. It all
Disclosure.
starts with disclosure.
Yep.
When you start the pre-qualification process, it's imperative that you disclose your whole situation up front.
Yeah, anything that you're thinking of. The way I think about it is the mortgage person you're talking to up front, he's going to be like your priest. You want to tell him as much as possible. He's not going to judge you. He's just going to take the information down and guide you in the right direction. And he's going to tell you what you need to use, what you don't need to use, and he'll direct you as to the best way to go about it.
Yeah, and I think most people don't disclose because they are ashamed or afraid or feel like they
Or
are
they
going to
think
be
it's going to hurt
judged.
their situation, so
Right.
they don't disclose because they think it's going to put them in a bad position.
But if it was disclosed up front, then you can do things to help them rectify that situation and put them in the best position. Because
Exactly.
there's nothing worse than getting to the end of the process and you're 1 week away from owning that dream home, and then because you didn't disclose something was revealed by the underwriter, and now you can't buy that home.
That is usually the biggest thing that comes up in the underwriting world, is that something's not disclosed up front, and it might not stop the transaction, but it adds time to it because it needs to be fixed.
Right. Right. That's important.
It's time. It's all about the time. We have a certain amount of days, to get the loan commitment and to get the deal closed. So we have to make sure we get the time to do it. So the more we know up front, the better off we are.
So you have a set amount of time that you need that loan commitment. What happens if that time comes and goes and there is no loan commitment? Does that mean the deal is dead, or is there something that can be done to extend that time?
Well, I mean, that would be, I guess, more on you. What I would do if for some reason we were
I'm
getting
the one
close,
interviewing you, not the other way around, Fred.
as a realtor, what I would typically do if we started getting close to the commitment date, I'm going to know if there's an issue.
Sure.
I'm going to know if there's going to be delays because of something. Maybe the appraiser can't get out there. Maybe there's an issue with the property that's being worked on still. So I'll know. I'll let the realtor know. What I'll do is I'll try to tell the realtor to get an extension for how many days we're going to need beforehand. And like I said, usually we know it shouldn't be the day of.
Right.
It happens the day of because a lot of times they think they have the information, they don't.
Right. Well, one of the biggest issues that arises towards the end of the process is, and a lot of buyers don't realize this, is that I think it's a week before closing you rerun the credit just to make sure nothing has changed. Well, from the time when someone got pre-qualified to the time you reran their credit, they went out to Jordan's Furniture, let's say, and bought $5,000 worth of living room furniture because they were going to be buying a house, and they put it on a credit card. Well, and now that's $5,000 more debt that wasn't accounted for, and that changed their debt to income ratio.
It happens.
It happens all the time.
What in the very beginning of the process, they don't even leave it to us. They have a processor send out a letter to the customer telling them not to spend any money and to call us and tell us what they want to do with their credit cards or buying a car, and we'll advise them what to do prior to so that they don't interfere with the mortgage that they're getting. But I've had people still go out and buy cars. Yeah. And it shows up on their credit. I can
afford a house, I can afford a car, you know?
But you're right, though. These people this particular person could afford to buy 2 houses.
Right.
The problem is that we have to then verify the information.
Correct. I've had a situation where one of my clients, they missed a credit card payment by 1 day. And the credit card, whoever owned it, reported it to the credit bureau 1 day after, and it changed their credit score, and they had to redisclose the whole loan, and then it changed their interest rate, and it was a disaster. So, like, make sure you're current on all your payments, make sure you're not taking out any new debt, including student loans. I had a client that didn't think a student loan was a debt for some reason, and that changed her situation a little bit. So make sure you're not taking out any new loan, make sure you're not buying all this furniture. Wait till after you close on the house.
What I tell people, obviously, wait until after. Even if you put something on layaway, if you go to Sears and put it on layaway, all these appliances, if it's attached to your credit card, it's probably going to show up on the report.
Right.
So you don't want to do that. You can pick out what you want, but that's it.
And these companies, you tell them, don't run it until after I close. They still run it somehow.
They still do it.
You know, it always finds a way
the other thing
to
is,
mess up the process.
The last thing, Anthony, is that we do have to verify if anybody's looked into your credit. So if you're going from Best Buy looking at appliances to Sears looking at appliances, and they're pulling your credit report, we're going to ask you, that's going to come up at the end of the process as well, and we're going to ask you, why are these companies pulling your credit? Did you apply for anything? Did you get any credit? Did you buy anything?
Right. Well, Fred, our time has come to an end, sadly.
It's fast.
It goes by fast, but you know what? I think we now can see that getting pre-qualified is the key to the home buying process. And I want to thank you for coming on the show.
You're welcome.
And sharing this information with the viewers. Again, Fred Damore, Ross Mortgage. I'm your host, Anthony Giglio, and we'll see you next time on Let's Talk Real Estate.